Welcome to The Explainer. Today, we're going to crack open one of the most misunderstood documents in the business world. And no, this isn't about dry numbers or confusing jargon. We're going to uncover the secret story that every single company's balance sheet is just waiting to tell.
Really think about that, because that's exactly what a balance sheet is. It's not just some boring snapshot in time. It's a biography written in numbers. It shows you a company's struggles, its big wins, its game plan for the future, and its health right now. So to start reading that story, we just need to learn the language it's written.
To really get the story, you first have to meet the characters. And our first main character is everything the company owes. This is what we call the liability side of the balance sheet.
Simply put, liabilities are a company's financial promises. It's all the money it has to pay back. Now, this could be short-term stuff, like paying a supplier for materials in the next few months, or it could be long-term debt, like a massive 25-year bank loan. It's basically the IOU section of a company's finances.
This is also where you find this really clever concept called provisions. So imagine a phone company sells 1 million phones. They know from past experience that some of those phones are going to come back for warranty repairs, right? So what do? They set aside money for that expected cost in a little piggy bank or a gluck. That money is earmarked for a future bill, so it's treated like a liability. Pretty smart.
All right, now let's flip the page to the other side of the story, what the company is actually worth to its owners. This is the equity section, and believe me, it holds some fascinating secrets.
Have you ever wondered why a share with a face value of just, say, 10 rupees might sell for 5,000 on the stock market? Well, that 10 rupees is the share capital. It's like the price printed on a stamp paper. But the market price, that reflects everything the company has built since then. The premium you're paying is for all those years of growth, profits, and potential. But where does that value actually come from?
Well, a huge part of it comes from what I like to call the mega piggy bank, retained earnings. See, after a company makes a profit and pays its taxes and maybe some dividends out to shareholders, the money that's left over is retained. It's all the profit that gets plowed right back into the business to fund new factories, new research, and all that future growth. It's the real engine of the company's value.
So we've got what a company owes, its liabilities. And we've got what its owners own, their equity. And those two things together pay for everything the company has, which are its assets. Now that we have all the pieces of the puzzle, we can actually put them to work and do a quick health check using two simple but incredibly powerful ratios.
First up is the current ratio. This is a fantastic little test for a company's short-term health. It takes the company's current assets, that's cash and other things that'll turn into cash within a year, and it divides them by its current liabilities, which are all the bills due in that same year. It's basically asking a very simple question. For every single dollar I have to pay out soon, how many dollars do I have coming in?
And just look at the wild difference this reveals in the real world. For JSW Infra, for every $1 it owes in the short term, it has nearly $20 coming in. That's a huge cushion. But Vedanta, well, it has only about 66 cents coming in for every dollar it owes. These are two very, very different financial positions to be in.
So you have to ask yourself, right? Which company's management team is probably sleeping a little more soundly when it comes to paying its bills on time? A high current ratio like that, well, that suggests a very comfortable financial pillow.
Okay, our next tool, the debt-to-equity ratio, changes our focus to the long-term game. It compares all the company's debt to the total money from its owners. In other words, it reveals a fundamental choice the company is making. Is it funding its big growth plans with borrowed money or with its own?
And this is where it gets really interesting, because there isn't just one right answer. It's all about strategy. Take these two hotel companies. Lemon Tree has a ratio of 1.20. That means for every dollar from its owners, it has borrowed $1.20. It's using debt aggressively to expand fast. Now look at EIH, the Oberoi Group, a tiny ratio of 0.05. It's growing mainly using its own funds. Both are totally valid strategies, but they tell completely different stories about risk and growth.
So when we start to combine these clues, the debts, the owner's stake, and these key ratios, the balance sheet stops being some static, boring report. It transforms. It becomes this dynamic lifeline, showing us exactly where a company is in its journey. Generally, a business moves through 4 key stages in its life. It kicks off with an initial stage, rockets into high growth, eventually settles down into a mature phase, and some, well, they enter a decline. And the balance sheet reflects
each of these stages perfectly. And we can actually see this story play out in the numbers. Just look at Zomato in its high-growth phase. Its assets are exploding as it expands, but it has very little debt because it's reinvesting everything it has. Then you've got a mature company like Colgate. Its assets, debt, and its reserves are all stable, growing predictably. And finally, a company in decline like Vodafone Idea. It shows a very different pattern. It's selling off assets while its debt keeps rising and its reserves are shrinking. The entire story is right there in the data.
So now we can see the narrative so clearly. The balance sheet points out the hungry, high-growth companies that are aggressively buying up assets. It shows us the stable, mature companies acting like predictable, cash-generating workhorses. And it warns us about the declining ones, the ones fighting for survival by selling assets to manage their climbing debt. It really is a complete biography of a company, just written in numbers.
So the next time you look at a company, just remember this. The daily stock price, that might tell you the market's mood, its daily whim, its fleeting feeling. But the balance sheet, the balance sheet tells you the real, deep, underlying story of where that company has been, where it stands today, and where it's trying to go. And now, you know how to read it.